A very good morning, friends. So, welcome you all to the topic, a very interesting topic today, and that is Ind AS 12. Ind AS 12 deals with income taxes and is a very important standard, not only from the examination point of view, but also if you look at the standard, you can't think of a practical work without the application of this particular standard. So I think we need a very good conceptual understanding both from the examination and a practical point of view. Please do excuse me because my throat is a little bad. So I think my voice may not be coming with a very good energy levels. So just my apologies for that. It's a little bad throat today. So in any case, maybe we may not be able to continue for the entire 3 hours today. So we have planned some extra session to make up the loss as well. But I'm sure, I would be able to continue for a good time, at least around half a class. So maybe I would expect, without putting much pressure on the neck. So I think let's start the journey. As they say that the show must always go on. Okay, so once again, a very good morning to all of you. So I'm going to first of all begin with the understanding of the standard. As if it's a pretty new standard to you, I'm not going to assume any based on account of what you've done. Yes, you might have already done accounting standard 22 in IGAP. But let me tell you, this standard is slightly different. The technique is slightly different as compared to what you might have done in AS 22 in IGAP. So I think let's start with the journey with a very basic understanding of the concept of deferred tax. The name of the standard is called income tax, but I'm going to start with the concept that it is supposed to be. First I want to elaborate the concept of a deferred tax. But a very first question what comes to the mind when I look at the standard on Ind AS 12 is, and a very pertinent question comes to the mind, and that is tax an expense? The very first question what comes to my mind is tax supposed to be an expense? Many people have the thought process that tax depends upon a PBT, a profit before tax. So they believe that tax is not an expense. So let me clarify one thing first of all. It is like any other expense. Let's say, for example, you say salary or you say depreciation. Tax, though, is dependent upon the PBT of the company, but it is certainly an expense. Even if you look at the Schedule 3, in the income statement format, you will notice in Schedule 3, they clearly use the word tax expense. And they very clearly mention that as far as the tax expense is concerned, it is a sum total of two items. One is called current tax and one is called deferred tax. This is a reference which I'm making to the income statement format, which is given in Schedule 3. It very clearly makes a mention that tax is an expense. So that tax expense is comprising of a current and a deferred tax. And we're going to concentrate on this deferred tax. Why is there a deferred tax? What is the need of creating a deferred tax in the company? So I'm going to take one simple example to illustrate the concept of deferred tax to you. But at the same time, let me caution. The concept I'm going to apply in terms of deferred tax is technically not correct. So I'm going to teach you something which is technically not correct, but don't worry, I'll rectify the same very shortly after the example. So let's take an example to understand why there is a need for creating a deferred tax in the books of accounts. So let's take an example. So I'm going to take a very simple example to illustrate the need of a deferred tax in a company. Now watch this example very carefully because it's a little mathematical example, but it would definitely throw a light in terms of why a deferred tax needs to be created. So let's consider these are the taxation books. Let's consider this is the taxation books, and let's consider a period of, let's say, 3 years, just a small period without taking much complications. And let's consider this is PBDT, a profit before depreciation and tax. Let's say this is 400 lakhs every year. So let's consider a common figure of PBDT, that is 400 lakhs each year. Now let's consider that the company purchased a machine on a scientific research, and we know that as per the income tax, we can get a full deduction of depreciation in the year of purchase as well. So let's assume that a company made a purchase of a machinery which is worth 90 lakhs, and you got a full deduction under the Income Tax Act. The income tax authorities gave you a full deduction of depreciation. So this is what I call my PBT. I guess I can comfortably call it as a taxable income. This PBT can be technically called as a taxable income. It is the amount on which you are liable to pay tax. Mind each and every word of what I say right now. This is the taxable income on which a company is liable to pay tax to the government of India. So this becomes 310, that is 400, and that is 400. And let's consider that if the tax is, I've just taken the taxation books as a base. I've taken the depreciation based on the income tax position, got my taxable income, and on the basis of the taxable income, I've computed my tax liability. Right? Now, let's make another statement. I'm going to make another statement now. And this is going to be the accounting books. So I'm making another set of statements, and this is accounting books. And let's consider the same 3 years period. The figures are in lakhs. So let's consider PBDT. Let's consider that from the accounting and the tax point of view, there is no differences between the PBDT. So let's consider same figure, that is 400 lakhs. And now comes the depreciation, which I'm considering from the accounting perspective. Mind you, I'm now considering the depreciation from the accounting perspective. So let's consider the depreciation based on SLM for a period of 3 years. So 90 divided by 3 is going to give me a depreciation of 30. This is purely from an accounting perspective. In the first statement, I took as per the tax, and the second statement I took as per accounting. So this becomes a PBT. Of course, we can't call this as a taxable income. So you know, I'm going to call this as accounting income. So this is going to be 370, and it's 370. So now, let's consider a tax at the rate of 40%. So we consider a tax at the rate of 40%. And if I take a 40% tax on this, it works out at 148, and that's common to all the 3 years. I guess I am pretty clear so far. You've got two statements. Just have a look at these two statements, because I'm going to ask you a few mathematical questions based on the discussion so far. And on this basis, I'm going to develop the crucial concept of what is a deferred tax. My question number one goes to you. The question number one is pretty simple. Let's take the sum total of these taxes, and let's take the sum total of these taxes and see what is the figure. This is 444, and if you take the sum total of this is also 444. Oh my God. You know what my question is going to be? The figure of taxes as per the two books of accounts is same. Now my question is this by chance, or is this what I call got to be? Let's, I think, get your inputs on that. So what do you say? Is this a pure chance, or do you think that this is got to be the taxes which have taken based on taxation concept and the taxes which have taken based on the accounting concept? I am getting a same amount of taxes for a sum total of 3 years. Do you think it's a pure chance, or do you think it is something which is bound to happen, that is got to be a pure mathematical question? So what's your inputs on the same? I think the data is very clear in front of you. In one statement, I've taken a depreciation of 90 in one go. In the other statement, I've taken a depreciation spread over a period of 3 years. And based on that, the total taxes for 3 years put together is equal in nature. Okay, so I think I didn't get any answer so far. I know it's a very tough question to ask early in the morning. That is the sum total of the taxes for the 3 years from the taxation and accounting is equal or not. I know my voice is pretty bad today. As I already said, it needs a little voice rest, so it's not coming out with that energy. But nevertheless, I guess we got the answer now. Yes, I think we get the answer. It is not by chance. Okay, that's right. So it is got to be wonderful indeed. Now, hear me very carefully, friends. Now, hear me very carefully on what I'm about to say. This sentence is a very crucial sentence. If tax is an expense, then why should I book the expense based on taxation rules? If tax is an expense, it should be based on accounting rules. That means when I'm going to record an expense in the books of accounts, I should record the expense based on accounting funda. When you book your revenues, you follow the relevant standard. When you book your other expenses, you follow the relevant standards. Which means without deferred tax, hear me carefully, without deferred tax, what was happening, company would recognize 124 lakh as an expense. But this is what you pay to the government. So were we indirectly accounting on a cash basis? I would say yes. Because we were computing a taxable income and we were recording what we were actually paying. So we were technically, following a cash basis that record what we are liable to pay in a given year. But technically speaking, if I am preparing the books of accounts, then even my expense, which is a tax, should be based on the accounting funda itself. Now see what we're going to do. Let me put the entries related to this concept. Let's go to the first year and let's have a look at the journal entry which I'm supposed to pass. So let's have a look at the journal entries which we're going to pass in year 1, 2, and 3. And watch this carefully in terms of what you need to record on the debit or the credit side. In the year number 1, I'm putting the tax expense debit. This tax expense debit should be based on the accounting funda. I need to record the expense according to the accounting funda. And what does my accounting funda tell me? That the tax is 148. I will accrue an expense equal to, mind the words carefully, I'll accrue an expense to the extent of 148. So we accrue the expense according to accounting. The figures are in lakhs. But when it comes to recording the liability, that is the tax payable, we are going to record what we are liable to pay as per the tax funder. The P&L item, mind the words, the P&L item is based on accounting and the balance sheet liability is based on tax. Watch this. This is the expense for the income statement as per accounts. And this is the liability in the balance sheet point of view, which is as per tax. I will not reflect liability, which I'm not supposed to pay. So if I go back according to the taxation, my liability is to the extent of 124. So I created 124, that is a tax payable. This tax payable can also be called as current tax payable. So this is technically called a current tax. So when I look at this tax payable, it is technically called a current tax, which you are liable to pay in this year. So what we're going to do, we're going to consider a balancing figure. This is the tax which I accrued, but I did not pay. This is a tax which I accrued, but did not pay. This is accrued, but this is not paid. Because I want to record an expense based on accrual concept, what I am supposed to pay. Now watch this sentence carefully. In year number 1, you are recording a tax if your accounting income was accepted as a taxable income. I repeat, if your accounting income was accepted as a taxable income, what is the tax you would have been liable to pay? If you go back to the statement, if your accounting income was accepted as a taxable income, you would have been liable to pay 148. So let's consider the accounting income as a base. Let's consider that if this is the taxable income, then I'm liable to pay this tax. Government incentivized me. They said, you got to pay less taxes this year, but I would not be able to claim a depreciation for the next 2 years, which would mean that I would land up paying more taxes in the coming year. As you can see, I paid a lesser tax this year, but it is compensated by a payment of more taxes in the subsequent year. So basically what I've done, the tax which I had to pay this year has got deferred over the next 2 years. So I've created what we technically call a deferred tax liability. This deferred tax liability, is it actual or is it notional in nature? It is purely notional in nature. This is not a liability which I'm technically supposed to pay to the government of India. They can't take me to the court of law and say that this year you paid 124, but you were liable to pay 148. It is only my book concepts. Because I want to accrue what I am liable to pay according to accounting concept. So my expense is getting accrued on the basis of what if my accounting income was taken as a taxable income. But my real liability, my actual liability is only to the extent of this tax. The rest is what we call a notional liability. And this notional liability is what we call a DTL. So let's go back to the entry, and we're going to record this as a DTL, that is a deferred tax liability. The balancing figure is 24. So let me tell you, this is, you can say, the actual liability, and this is what we can say is purely a notional liability. So we've created a complete notional liability in the books of accounts in the year 1. I hope I am pretty clear so far at this stage, right? Let me see if any questions are coming to your mind so far on this. That's right, Namrata, wonderful indeed. So you said because there is a cost of asset is same. Yes, the logic given was very clear. Absolutely. Great. Now let's do one thing. Let's go to the year number 2 and let's go to the year number 3. So let me now go to the year number 2 and then we'll have a look at the third year as well. Again, the concept remains the same. I'm going to record the tax expense and this tax expense will be recorded according to the accounting funda. I'll say that if my accounting income was accepted as a taxable income, I'm going to record something which is based on the accounting concept. So 148 is the tax expense to be taken. Figures are again in lakhs. But the liability is equal to based on a taxable income. So I go back and I see what is my liability as per tax. That is 160. Okay. So we create a tax payable, or we can say a current tax, and that is to the extent of 160. Now there is a gap, and I think you very well know that this gap of 12 is to be adjusted how? Mind the words just for explanation. Internally in my books, I am going to say there was a liability of 12 which was outstanding in the end of the first year. A part of it has been paid in the second year. Out of this 160, 148 is technically for the current year, and 12 is what is paid for the previous year. I put it again. So we are internally saying that I paid more taxes to the government, but technically 148 is what I paid for the current year, and 12 is what I paid for the previous year. So it is, you can say, a payment of the deferred tax liability, which we can take as a balancing figure 12. So you can say out of this, we paid a liability 12. It is notional in nature. This DTL is not an actual liability because I want to reflect an expense according to accounting. So I said I'll record according to accounting, create a liability as per tax, and any differences is a reversal of a DTL. In the year one, you created a DTL. This is originating in nature. In the second year, you went in for what we call a reversal of DTL. So this notional liability is getting created in one year and it is getting reversed in the subsequent years. But what is important is that if it gets created in one year, it must reverse completely in the coming years. Okay, let's go to the third year. If I go to the year number 3, I think the figures are absolutely similar to the second year. So can I say I'll have the same entry as year 2? I'm going to get the same entry as year number 2. Now watch this out. 24 DTL created gets knocked off 12 in the second year and 12 in the third year. That means the DTL which got originated in year 1 end got reversed in year 2, and in year 3, the notional liability is gone. Is there any impact in terms of the taxes which I'm paying to the government? No. You created a liability of 124, so you paid a tax 124. You created a liability of 160, so you paid a tax of 160. So which means every year, the amount of taxes which you're paying, which is getting reflected in a balance sheet, is equal to the actual payment which you're going to go give to the government. But the expense which you want to put in the income statement is based on accounting concept. I hope with this example, I made myself clear on the concept of a deferred tax. Another concept. In my example, the expense is more than the liability. If it is the other way around, it creates a DTA. And that DTA will also get adjusted in the subsequent years as well. So this is the concept of a deferred tax. If somebody were to ask me that, just tell us in one sentence. So if somebody were to ask me, just tell me in one sentence, what is a concept of a deferred tax? I would say, you accept my accounting income as a taxable income. Let me calculate the accounting income as per the accounting funda. Let me consider that to be a taxable income. So whatever is the amount of taxes which you will get on that, please record that as an expense. And the liability which you're going to record is something based on what you're liable as per the income tax provision. record that as a liability. So the debit side of the expense accounting based, the sorry, the credit side of the entry is going to be based on taxation concept. Any difference in the debits and credit, if the debit is more, it creates a DTL, and if the credit is more, it creates a DTA. Because the only concept we wanted to follow, that tax is an expense, and it should get recorded in the books of accounts based on accounting format. Right, I guess, friends, I am pretty clear so far on this stage. Okay, that's great. So now let's do one thing. In the past 15-20 minutes, I told you that I'm not technically teaching you the right thing. There is something which is problematic, and I think now it's time to tell you that what is the problematic issue. Let's take it further. There are two approaches to calculate a deferred tax. One is called an income statement approach, and one is called a balance sheet approach. Now watch me carefully. As I said, there are two approaches to calculate a deferred tax. One is called an income statement approach. One is called an income statement approach, and the other one is called a balance sheet approach. Interestingly, the example and the concept which I gave you is an income statement approach. I looked at a depreciation in taxation books. I looked at a depreciation in the accounting books. So we were looking at an income statement comparison. Accounting Standard 22, which is your IGAP, is based on an income statement approach. So the concept which I developed was based on an income statement approach. But if you look at Ind AS 12, it is based on a balance sheet approach. Now, I know a couple of questions would start arising in your mind. Are the two approaches similar? Are we going to get same results based on the two approaches? No. So what are the areas where we will get a difference? Which is a better approach? Let me tell you one thing, that a balance sheet approach is a much wider approach. So what you've done in AS 22 is the intermediate level was based on income statement approach, comparing the incomes, comparing the expenses in the accounting and the taxation books. But in a balance sheet approach, you're going to compare the assets. You're going to compare the liabilities in a balance sheet perspective. I know you're thinking, so can you take an example, a very basic example to illustrate how the two approaches would work with the same example? Why not? Let's do one thing. Let's consider a very basic example to illustrate the concept with the help of an income statement and balance sheet approach. Now, this is a very simple example, but you cannot apply this to every situation. The answer could be different. Let's consider we made a purchase of a machine, let's say to the extent of 1,000. Now, I want to consider that this is accounting books and this is taxation books. I want to consider what is the depreciation I've taken in year number 1. So the cost of the asset is 1,000 at the beginning from the accounting and the taxation perspective. Now, from the accounting point of view, let's say you are considering a depreciation, let's say 100. But from the tax point of view, let's say you're considering a depreciation 150. Now, mind it carefully. You've taken more depreciation in tax. Your taxable income will go down. I repeat, hear the words carefully. You've taken more depreciation in tax, which would mean your taxable income will go down, but your accounting income will be greater. Now, in this particular case, we can say if the accounting income is going to be greater as compared to the taxable income, if your accounting income is going to be greater as compared to the taxable income, we can definitely say this will create a DTL. Because you will create a tax expense according to accounts, which is greater, and you will create a tax liability, current tax according to taxable income. So you will get a DTL, which is nothing but you can say 50, the difference into a tax rate that is 40%, it comes to 20. So that means in year one, if I look at the income statement, since you've taken lesser depreciation in accounts, the accounting income turns out to be great. And we used to say that if the accounting income is more, then in this particular case, it would result in, you can say, creation of a DTL. And if it is vice versa, then it creates a DTA. Now, let's watch this from the balance sheet perspective. Now, let's see the same example from a balance sheet perspective. The cost of the asset is 1,000. And now let's consider that from the accounting and the taxation point of view, what is the value at the end of year one in the balance sheet? I'm looking at the value of the asset. I'm not looking at the income and expense in the income statement. I'm looking at the value of the asset and liability in the balance sheet. So out of 1,000, you took 100 depreciation. The value of the asset is 900. From 1,000, you took 150. The value of the asset is 850. It's a little early to explain in a balance sheet approach when it would create a DTL or when it would create a DTA. I'm going to develop that concept later because I have a 5-step model which I've created for the purposes of this Ind AS. It is not given in the standard. This is for the ease of convenience that I've created my own 5-step model, which I'm going to teach you. And once you're done with the 5-step model, trust me, you're going to rub this even in a practical situation. So you can again see the difference between the book value of the asset in the accounting and the tax is again 50. The difference in this case in the depreciation in the two books is also 50. So this 50 multiplied with a tax rate of 40%, we're going to get the same DTL. So you can see the DTL in both the cases by a balance sheet approach and an income statement approach is same. Now you would say, looking at this example, that means every time you compare the income in the two books or expense in the two books, or you start comparing the value of assets in the two books, or you start comparing liability in the two books, you're going to get the same results? No. All I can say at this stage to begin with, because it's a little too early to elaborate things to you, but I can say the balance sheet approach is a much wider approach. There are a lot of transactions which do not get captured under the purview of an income statement approach. Now, don't ask me examples at this stage. We'll be able to develop examples once we get on to the understanding of this standard. But I can tell you one thing, at this very stage, a balance sheet approach is a much wider approach. Not all differences gets captured in an income statement approach. It is not a very wide kind of approach, but balance sheet approach takes care of all the kind of differences. So it is considered much wider. So we need to understand that for the application of this standard, we need to apply a balance sheet approach, comparing the value of the assets in the two books, comparing the value of the liabilities in the two books, and then getting the difference instead of comparing the incomes, instead of comparing the expense. So since morning, when I started over the understanding of the standard, what I did, I gave you an example based on an income statement approach. That was only to develop an understanding that when you're recording a tax expense, it is based on accounting funding. When you're recording the liability, it is based on a balance sheet funding. And the difference is a deferred tax. And why we are creating a deferred tax? Because tax being an expense, I need to accrue it according to the accounting concepts itself. I hope, friends, I am pretty much clear with my logic so far, right? So I guess there is one question coming in from Jabbi. Sir, there will not be any treatment of difference in expense amount other than taxation component of such expense? No. Well, whenever there is a difference between an expense in the two books, you can say this would lead to impacting both current and deferred tax. Similarly, if there is going to be a difference in terms of a balance sheet, asset and liability in the two books, it would lead to impact on both current and deferred tax. We will develop more understanding now, but I hope the basic conceptual knowledge is clear. You should be able to now appreciate the need of a deferred tax. Why does a company create a deferred tax in this case? Okay, I guess let's take it ahead. Now, as I said, I created a 5-step model. And trust me, this 5-step model will give us a very ease of understanding of the standard. So let me first of all give you what is the 5-step model we will follow for the purposes of this standard. For the purposes of Ind AS 12, I'm going to apply a 5-step model. Let me caution, this is not a model given in the standard, but this is a model based on my conceptual understanding in terms of the practical life situations, and then I develop something which is ease both in examination and in terms of the practical life. So follow this 5-step model. You trust me, you can do any kind of complicated questions. We'll be slowly coming to the examination kind of problems also, but first we'll develop the basics. The step number 1 is to calculate what we call the book value, or you can say the carrying amount. You need to calculate the book value, or what we call the carrying amount of every asset and liability in the balance sheet. So this is the first step, that you need to calculate a carrying amount, the carrying amount or the book value for every asset and balance sheet. This is from the accounting perspective. So this is purely from the accounting perspective. So if this is from the accounting perspective, is there a role of Ind AS 12 in this step? No. If you want to calculate the value of inventory, what do? Ind AS 2. If you want to calculate the value of a PPE, what do? Ind AS 16. If you want to calculate the value of intangible assets, what do? Ind AS 38. Step number 1 is got no role in terms of this standard. You need to organize the value as per step 1 based on relevant Ind AS. It is based on the applicable standards. It is based on the applicable standards. So if you get a item in the exam inventory, get the book value as per Ind AS 2. If you get a machinery, get the value as per Ind AS 16. If you get an investment property, get the value as per Ind AS 40, and so on. Look at what is the relevant standard applicable to the asset or liability and get the value. Simple. No role of Ind AS 12 in step 1. Then you go to the step number 2. Go step by step. You'll never go wrong. Then in terms of the step number 2, we need to organize what we technically call a tax base. And I think you can guess it well. This is organizing the value of the assets and liability, and this is from the point of view of taxation. This is from the point of view of taxation, and if you're looking at the value of the assets and liability from the taxation point of view, here Ind AS 12 comes into the picture. It gives you a definition of what is a tax base of an asset. It gives you a definition what is a tax base of a liability. So this is based on Ind AS 12. The calculation of the tax base is going to be purely based on Ind AS 12, and today we're going to focus on step 2 largely. We're going to focus mainly on step 2 because many people get a problem in terms of calculating a tax base. I'm going to give you a very easy approach which will give you a tax base of an asset and liability with logics. Let's go to the step number 3. Step number 3 is nothing but it is a comparison of step 1 versus the comparison of step 2. We're just going to compare the carrying amount and the tax base. This difference will be called as a temporary difference. So when you would compare the carrying amount versus the tax base, we are going to get what we call temporary difference. We are going to get what we call technically a temporary difference. This temporary differences will be further classified as taxable and deductible. When do they become taxable? Or when do they become, deductible? Don't worry, we'll see that later. But we're going to classify these temporary differences as taxable and deductible in nature. How does it become taxable or deductible? Don't apply your mind at this stage. You just need to remember that once you will compare the step 1 and step 2 values, you're going to get a temporary difference. And that is either taxable or deductible in nature. Then we go to the step number 4. In terms of the step number 4, what I need to do, the taxable or the deductible differences are not the deferred tax. What we're going to do in step number 4, if you get a taxable temporary difference into a tax rate, you're going to get a DTL. The step number 4 focuses on the tax rate, the application of the tax rate. This tax rate we'll discuss separately in step 4, but step 4 is the selection of a tax rate. You will say, what's the big deal, sir? The tax rate will be given in the question. Yes, from the examination point of view, it may not be of much challenge. But yes, we need to select a tax rate so that the figure of what you computed in step 3 into the tax rate is going to give you a DTL. This DTL is the balance sheet figure. It's not the amount for the income statement. So this DTL which you will get is a balance sheet figure. Similarly, in terms of the step number 4, if you get a deductible temporary difference, if you get a deductible temporary differences, this is to be multiplied with a tax rate. So the focus is what rate do we consider? And once you multiply this, you are going to get a DTA. And this DTA which you're getting is also supposed to be a balance sheet figure. So you can say the step number 4 is an application of a tax rate. The taxable and the deductible differences identified in step 3 needs to be multiplied with a given tax rate to get the DTA or the DTL balance sheet figure. Finally, we come to the step number 5. Finally, we come to the step number 5. And this is what I call recognition. This is what we call recognition. Now, hear this carefully. Though we're going to discuss the details later, but just to give you a very basic flavor of the step 5 recognition. Since you've done Ind AS 1, so I think I'm wanting to ask a very basic question. Let's quickly get your answers on that. Can you tell me, in Ind AS in Schedule 3, income and expense gets recorded at how many places? What are the number of places where an income expense may get recorded? I want you to give me the number. Is it 1? Is it 2? Is it 3? Is it 4? Whatever. I want to understand from your point of view that when you record an income and expense in Schedule 3, financial statements, where do you put the income and expense? How many places are there where you record the income and expense? I think let's get that answer from your side. Okay, number 3, you said, sir, if in future taxation law changes, can we reverse DTA, DTL? Too early to answer that. I'll be coming to that shortly. You said it means we need to understand all the standards related to assets and liability. First step number one, yes. So my friends, my simple question to you, I want you to tell me how many places are there in Schedule 3 where you record an income and expense. I think that's a very pertinent question. This is what you've done on Ind AS 1, and you would know that when an item, sorry, when an item of income and expense is recorded, what are the various places it gets recorded? Okay, I think I got the first answer from Namrata, profit and loss account. Okay, let's get more answers. What are my other friends going to give me inputs on that? Give me the various places where the income and expense gets recorded in the financial statements based on Ind AS. Okay, we just got one answer. Well, you can also say, I don't know. That's another option to answer. If you're not very sure, then do tell me, sir, I don't know where the income and expense gets recorded. So I think we got some more answers. Janvi tells me 2 and Shriram tells me 2. Okay. Now watch this carefully. I'm going a little out of this Ind AS 12 and I am going to take you a bit on the financial statements. Now watch this carefully. You know, when a company makes the financial statements based on Ind AS, when a company makes the financial statements based on Ind AS, you prepare an income statement, and this income statement has got two sections. One is the profit and loss, and one is OCI, that is other comprehensive income. And you already know something, that if a company calculates the net profit, let's say the net profit is 20 lakhs, and the amount of profit which you calculated in the OCI, let's say is to the extent of, let's say the income recorded is to the extent of 10 lakh, you get a total comprehensive income. We get a total comprehensive income that is 30. So certain income and expenses gets recorded in the P&L, and certain income and expense gets recorded in OCI. Well, I don't want to get into at this stage that which items of income and expense goes in the P&L or which item goes in the OCI, though the list is given in Ind AS 1, but as you go to study these standards, you'll be getting a clear-cut logic also why items are parked in the OCI or why items are then put in the P&L. There are certain items which are recycled to the P&L later, and there are certain items which are not, but I don't want to get into all that. But we know one thing, that income and expenses may get recorded in the P&L or income and expense may get recorded in the OCI section. And when you prepare a balance sheet, there is an accompanying document, what we call SOKI, Statement of Changes in Equity. Trust me, there are certain income and expenses which are taken in SOKI as well. You know, when you look at the statement of changes in equity, you got an opening balance. If you look at the Schedule 3 format, there is an opening balance, and then it says add or less. It says add or less the changes in accounting policies. It says changes in accounting policies and errors. And then it says you get what we technically call a restated. Technically, what we get is a restated opening balance. So there is a few items. For example, if there is an error which is located in the current year, it doesn't get recorded in the P&L. It doesn't get recorded in the OCI. So there are certain things which are recorded directly in SOKI. So this is the third place where certain incomes and expenses gets recorded. I don't know what you're thinking. You will say now, sir, that means I need a complete understanding of all the Ind AS. And I need to understand that this income and expense goes in the P&L. Yes. This income and expense goes in the OCI. Yes. And this income and expense is directly recorded in equity. Yes. Because when there will be a deferred tax, hear this carefully, when there will be a deferred tax on an item which goes in the P&L, the related deferred tax will go in the P&L. When there is an item, which is related to the OCI, the related deferred tax will go in the OCI. Similarly, if there is supposed to be an item, which is recorded in the equity directly, that is SOKI, the related deferred tax will get recorded in SOKI. Don't worry. We'll come to some more examples when we come in detail on step 5, to the extent you get a complete understanding. But the problem in terms of IGAAP was that every income and expense used to be taken to the P&L. There was no concept of OCI in IGAAP. There was no concept of SOKI in terms of IGAAP. So every income and expense used to get recorded in the P&L. So what you used to do, whether you were creating a deferred tax asset or liability on any item of income and expense, you will end up putting it in the P&L. But now that's not the case. For example, if you say that there is a deferred tax arising due to error, it will go in SOKI. I'm going to create a deferred tax through SOKI. If you say there is a revaluation of the asset, I know it goes in the OCI. So the related deferred tax will also get recorded in OCI. If you say, for example, the difference in the value of the asset is due to depreciation, the depreciation enters in the P&L. Okay, so let me put the chain. You're comparing the value of the assets in the two books. The difference is due to depreciation. I'll put across a question, where is depreciation taken? Profit and loss section, deferred tax in the P&L. There is a difference between the value of the asset in the two books due to revaluation. Where is the revaluation taken? OCI. So where would the deferred tax go? OCI. Sir, if there is a difference in the value of the asset in the two books due to depreciation and due to revaluation, are you going to split the deferred tax between P&L and OCI? Yes. There is a question in the study material, which is also come in the RTPs and I think in the exams as well. A very popular kind of question, where they're looking at your understanding of step 5. That if there is a difference in the value of the asset in the two books, or the difference in the liability in the two books, what is the associated income and expense? Where did you take that associated difference? That associated difference is taken in the P&L, deferred tax through P&L. The associated difference is taken in the OCI. We will take the deferred tax in OCI. If you've taken that associated difference directly in equity, SOKI, your deferred tax gets recorded in SOKI. This is only a very basic understanding so far. So let me take the journey forward and let me now give you some more inputs on this step number 5. So when I'm looking at the recognition, it either gets recorded in the P&L, or it gets recorded in the OCI, or it gets recorded directly in equity, that is SOKI. So this is my step 5. So we've got a comprehensive 5-step model on the application of Ind AS 12. Let me consolidate the picture to you. Let me, consolidate the picture to you. I'm again cautioning you, friends, the Ind AS 12 does not give you any 5-step model. This is only for the ease of understanding that I have divided the standard into 5 steps. You got to become an expert in each of these steps. Trust me, any kind of question, we will crack it. So let me just again remind you, today, because of back throat, we will not have a 3 hour session, probably around 1.5, and even tomorrow. But whatever portion will be left over, we will cover that on Sunday. So I've requested to the Board of Studies for an extra class on Sunday. They've been kind enough to allot an extra session to compensate for the losses of today and tomorrow, because I've been advised a little speech rest in terms of things, but I think still a little better. So I guess another 1 or 2 days I'll become more better. So I think things will come out more with the energetic levels as well. Okay, but I hope the energies are not very lacking indeed. Though yes, compared to my original self, there is a temporary differences which is going to get knocked off in the coming few days. Okay. Now hear me very careful listening, and let me just consolidate the industrial steps before we go to the step number 2 in detail. It's a simple 5-step model. What do you need to do in terms of industrial? Step number 1, organize the book value or the carrying amount of every asset and liability in a balance sheet. This is a rule of the relevant standards. I'm not going to teach you step 1 because for the purposes of this standard, the examiner is going to give you step 1. So I'm not worried on that. It would be a very basic kind of knowledge where you need to get the book value of the asset and liability. That's it. Second step is calculating a tax base from the taxation perspective. This is a crucial step. We need to be very careful on a tax base, where I'm just going to start the journey on the tax base right away. Step number 3 is a mathematical exercise. Compare the carrying amount and the tax base, and you will get a temporary difference. It's a simple mathematical exercise where you would compare and get a temporary differences. This will be classified taxable and deductible. How? We'll see. It's just getting a temporary difference, classifying it as taxable or deductible. Step number 4 is choosing a tax rate. A taxable differences will lead to DTL. Why? We'll see. A deductible differences will lead to a DTA. Why? We'll see. But we're looking at that you need to select a tax rate. So that I can multiply the temporary differences into a tax rate, get the DTL or DTA for the balance sheet point of view. And then step number 5 is the journal entry, the recognition. Where are you going to record the deferred tax? P&L, OCI, or SOKI? We'll see that. We'll take some examples towards the end. Once we're done with the 4 steps, that how do you consider that this deferred tax is through P&L, or is it OCI, or is it going to be through equity? I guess so far so good. I believe you've all well understood the need of the standard. That's 1. And I guess you've also understood in terms of the other area as well, and that is the 5-step model which I've given you. Okay, so let's begin the journey, friends, with you. I'm now going to go to the step number. Now hear me very carefully. I'm going to take you to the language of the tax base of an asset. I'm going to concentrate first of all on the tax base of an asset, and then I'm going to talk in terms of tax base of a liability. Watch me very carefully, hear me very carefully, don't worry on the notes. I'll give you the notes later, but first, I'm just going to read something. I've just taken an extract of the tax base definition, which is given in the standard. So let me just take you to the definition. I guess this should be visibly clear. So let me just come to the definition of tax base of an asset. So let's have a read very carefully and hear my words very carefully. Tax base of an asset is the amount that will be deductible. The word is very clear that tax base is the amount that will be deductible. Will be deductible means future deduction. It means future deduction. for tax. So future deduction as per Income Tax Act. I'm just reading the definition and trying to interpret the words. The logic will come very soon. The tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits. The future deduction against taxable economic benefits. The definition says the deduction you will get against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the assets. I'm not reading further. Now please hear me very carefully. If you get this, you get it in 2 minutes. And if you don't get this, you don't get this for next half an hour. Now watch me carefully. Can I say every asset in the balance sheet gives you a future economic benefits? Your asset cannot appear in the balance sheet unless it gives you a future economic benefits. Agreed? I'm making a very strong statement. I'm saying every asset in the balance sheet of the company definitely, I'm saying 100% definitely gives future economic benefits. So can you illustrate? Can you elaborate? If you look at, for example, these standards like Ind AS 16, the standard like Ind AS 38, the standard on Ind AS 40, or the standard on Ind AS 41, I'm looking at certain standards which are asset-related standards. On asset-related standard, you've got Ind AS 16, which deals with PPE. You've got Ind AS 38, which deals with intangible assets. You've got Ind AS 40, which deals with investment property. You've got Ind AS 41, which deals with agriculture, where it talks of a particular asset called biological assets. You know what is common in terms of these standards? If you read the recognition criteria, which is given for these assets in the respective standard, trust me, if you read the recognition criteria in every standard, the word is given future economic benefits need to be probable. A company cannot capitalize a PPE or intangible assets or investment property or a biological assets. The standard very clear is go and prove it to me that it is probable that future economic benefits are going to be derived. And then you know what? After applying these standards, you also apply Ind AS 36, which is dealing with impairment, which puts a brake on the fact that if there is any asset which is not going to give you economic benefits more than a certain amount, a recoverable amount, you restrict it. You bring the value of the asset down. So these standards ensure, the standard ensures that whatever value appears in the balance sheet of the company will get at least those economic benefits. So, if somebody were to ask me at this stage, can I say the carrying amount of the asset is as good as a future economic benefit? If somebody were to ask me, give me a nickname for a carrying amount of the asset, I'll say simple. The carrying amount of the asset represents what? The future economic benefits. So every asset in the balance sheet of the company will definitely give you a future economic benefits. So you can say the asset is appearing in the balance sheet In the future, it will give you economic benefits. But now, what you need to understand is, agreed that every asset will give you future economic benefits, but you need to decide when the benefits will arise, will it be taxable or will it be not be taxable? In simple words, आपने अपने आप से क्वेश्चन पूछना है, जब एसेट से इकोनॉमिक बेनिफिट्स आएंगे, क्या इनकम टैक्स वाले आकर उस पर टैक्स लगाएंगे? Put it very clear. When the benefits will arise out of the asset, will the income tax authorities come to you and tax you? The answer is either yes or no. Now you'll say, can you give an example? I will. So what you need to put across is that when the benefits will arise in the future, will the income tax people come and tax those benefits? Let's take two basic examples. Let's say I have a PPE. It will give me future economic benefits. Yes, it will give you future economic benefits. You'll use the machine to produce goods and service. The revenue arising from the sale of goods and services will be taxable or not? Yes, sir, it will be taxable. So when the economic benefits will arise from a machine in the form of sale of goods and services, those sale of goods and services will be taxable. So we can say, yes, it will be taxable in nature. Let's take another example. Let's say you've got a debtors account receivable in the balance sheet. Would the economic benefits arise? Yes. I will do the collection from the debtor. If you do the collection from the debtor, the economic benefits will be collected in the form of collection from debtors. But would it be taxable? When you collect the money from the debtors, would the income tax authorities come to you? No. When you made a credit sale, the credit sale was recorded as a part of your taxable income. So when you go to collect the money from the debtor, they're not going to do a double taxation. They're not going to come again and tell you that, you got to pay taxes on that amount. So you need to see that when the benefits will arise, will the income tax people come and tax at that time or not? You need to be futuristic. In a deferred tax, you need to be futuristic. You need to get the trail very clear. When the benefit arises, will the income tax authorities come or will they not come? Now, when you say they will not come, when you say that they will not come, it will not be taxable. There are only three reasons of their not coming. जब benefits आएंगे, income tax वाले आएंगे. आप कह रहे जी benefits आएंगे, लेकिन income tax वाले नहीं आएंगे. So the benefits will arise, but the income tax people will not come. There are only three reasons when they will not come. There cannot be a fourth reason in life. There are only three reasons they will not come. They already came in the past. So double taxation to hogi nahi. Number two, it is exempt from tax. It is exempt from tax, so therefore they will not come. And number three, it's not income, it's a capital receipt. It's a capital receipt. So I think we need to sharpen these skills, first of all, on this area, that I give you example that, okay, the benefit is going to come from the asset. You need to decide income tax will come or not come. Then we'll go to the next step. So you just need to take a decision, will they come or they will not come? They will not come for three reasons. Either it is exempt, or it is already been taxed. Get the words clear. It is already taxed, it is exempt, or it is a capital receipt. So the three reasons that they will not come is, number one, you can say that it is already taxed. You can say it is already taxed, or you can say it is exempt from tax, or I can say that it is a capital receipt. It is supposed to be a capital receipt. It's not a revenue income on which I pay taxes. So you need to get your skills sharpened now at this stage, that when I say, okay, this is the asset, you need to think, okay, when I'll get the benefits, इनकम टैक्स वाले आएंगे कि नहीं आएंगे. अगर आपने कहा इनकम टैक्स वाले नहीं आएंगे तो तीन रीजन बन सकते हैं, आ चुके हैं, एग्जेम्पशन है, या कैपिटल रिसीट है. Is my chain very clear, friends? I guess my chain is very clear. Okay, so I think I've got some questions. Okay, so I think yes, that was answers given. Okay, I hope my concept is very clear. Let's begin the journey. I'm not going to give you example. If you can answer them. Otherwise, I'll of course give you the answer. So let me begin. I'm going to give you some examples of assets. I'll come back to the definition again. But first, what's the example? I'll give you the name of the asset. You need to decide फ्यूचर में जब बेनिफिट्स आएंगे इनकम टैक्स वाले आएंगे कि नहीं आएंगे. Let's say I'm looking at PPE. When the future economic benefits will arise, yes, they will arise. In what form will they arise? You will be able to produce sale of goods and services. The machine will be used in the production of goods and services, and therefore the economic benefits will arise. You need to decide इनकम टैक्स वाले क्या इस बेनिफिट्स पर टैक्स लगाने आएंगे कि नहीं आएंगे. Are they going to come and tax you? क्या इनकम टैक्स वाले कहेंगे, ओहो, you earned some revenue by sale of goods and services, भाई साहब टैक्स निकालो. So are they going to tax you on that particular amount? Yes, it will definitely be taxable. Now please hear this carefully. Let us say you produced the sale of goods and services to the extent of 2 lakhs. Will they be able to charge a tax on 2 lakhs itself? No. I will say, boss, against this 2 lakhs, I will claim a depreciation of this asset. In order to produce the goods and sell it at 2 lakh rupees, I incurred a depreciation. So I will not pay a tax on 2 lakh. I will pay a tax after claiming a depreciation in relation to the asset. So the tax base, what Ind AS 12 tells me, is a future deduction. I will tell them that I will claim a deduction against the taxable income. I will say I will claim a deduction against the taxable income. So let's say the machine is, let's say, was costing, let's say the machine is costing, let's say to the extent of 3 lakhs, and the book value of the asset is 2 lakhs. So you've taken the book value equal to 2 lakh sale of goods. Yes, this is not by chancing. The carrying amount basically represents the future economic benefits. कम से कम उतने benefits तो आएंगे. So when you will use the machine, then it will give you economic benefits at least equal to the book value. इतने benefits आएंगे. उसके against आप कितनी deduction ले पाएंगे? Let's say out of 3 lakhs, you've already claimed 1.5 lakh depreciation. So what is the further depreciation you're going to take? You're going to take a depreciation, another depreciation to the extent of 1.5 lakhs. I will ask myself a question, what is the future deduction I will claim? 3 lakhs, 1.5 lakhs already claimed as a depreciation in Income Tax Act. Another 1.5 lakhs will be claimed in the future. Now see what we are technically doing. I am technically saying that this is what? The carrying amount. The future deduction is what? Indirectly a tax base. What is the future income? The carrying amount. What is the future deduction against that income? 1.5. Can you tell me will there be a net income or a net deduction in the future? ये इनकम फ्यूचर में आएगी, इसके अगेंस्ट इतनी डिडक्शन मिलेगी. So you will earn 2 lakhs in the future and claim a deduction 1.5 against that income. So 0.5 क्या बना? Net taxable income. So this difference, that is 0.5 lakh, is supposed to be what? It is called a taxable temporary difference as per step number 3. Right? So this is called a taxable temporary difference, that is 0.5 lakh. So basically when you're working on step 1, step number 1 is the future economic benefits or the future taxable income. The carrying amount of the asset is the future economic benefits, which we are saying is like a future income. And what is the tax base? It is a deduction against that income. मैं सरकार को पूरे 2 लाख पर टैक्स थोड़ी दे दूंगा. मैं कहूंगा कि 2 लाख को कमाने के लिए मैंने डेप्रिसिएशन का एक्सपेंस इंकर किए. सो यू नीड टू गिव मी अ डिडक्शन 1.5. सो व्हाट विल बी टैक्सेबल? द नेट अमाउंट विल बी टैक्सेबल. ये अमाउंट टैक्सेबल होगा, इस पर टैक्स दूंगा. व्हाट डू यू कॉल इट एज? लेट्स से इफ देयर इज अ टैक्स रेट टू द एक्सटेंट ऑफ लेट्स से 40%, तो इस पर 40% टैक्स आप देंगे. 40% would mean that it is 0.2 lakhs. So what do you think it would be? DTA or a DTL? Tax दूंगा. It's a DTL. And the difference is due to depreciation. The difference in the carrying amount and the tax base is due to depreciation. So where are you going to record this DTL? You're going to record it through profit and loss. So can you please consolidate all this once more? Yes. Let me consolidate the entire position once more. You need to be very clear on the chain of thought. जब asset से economic benefits आएंगे, when you are going to get economic benefits in the future, you need to put across the question, will the income tax authorities come to tax you or not? Get the chain very clear. When the economic benefits will arise in the future, will the income tax authorities come to you or not? या तो आएंगे या नहीं आएंगे. If they don't come, there are 3 reasons that they will not come. Number 1, they already came in the past and taxed you. Number 2, it is exempt. And number 3, it's not a revenue receipt, it's a capital receipt, not subject to tax. So there are only 3 reasons that when a benefit arises and they will not come to you. So we need to sharpen the skills on the area that when the benefits will come, whether income tax authorities will come or not. So if you say that the benefits are taxable and they will come, your tax base is a future deduction. You will tell the government that this is the carrying amount, so this much benefits will arise. ये आप अपने आप से कह रहे हैं. That carrying amount represents the future income. So the asset will give you a future income at least to the extent of carrying amount. The asset will give you a future income at least to the extent of carrying amount. So this is the future income. अब इनकम टैक्स वाले आगे 2 लाख पर टैक्स लगाने, मैं कहूंगा कि 2 लाख पर टैक्स कैसे लगाओगे? इस इनकम को कमाने में एसेट यूज किया मैंने, उसकी डेप्रिसिएशन क्लेम करूंगा. आप नेट अमाउंट पर टैक्स लगाएंगे. नाउ यू वुड से, सर व्हाई ओनली डेप्रिसिएशन? व्हाई नॉट द कॉस्ट ऑफ गुड्स सोल्ड? I am considering a deduction only with reference to the asset, given asset. I'm not interested in a total deduction. When you go to calculate the current tax base on the inventory, you take care of the deduction of cost of goods sold. Right now, we are only considering that against this income, what deduction will be available for the asset. I'm only concerned with the deduction you will get for the asset. So I will tell the government that you have already given me out of 3 lakh 1.5 lakhs, I've already taken a deduction. So I will be able to claim a further deduction against this income. So once I get a deduction against this income, I'll get a net difference. ये कमाएंगे, इसके against ये claim करेंगे. So there will be a net taxable difference जिस पर tax देंगे. So step 1, carrying amount. Step 2, tax base equal to future deduction against the income. Step 3, taxable difference. Step 4, DTL. Step 5, where do we take it? Why is there a difference between a carrying amount? Depreciation. Where does the depreciation go? Profit and loss. So where do you take the related deferred tax in the PL? Step 5. I hope, friends, my chain is very much clear indeed, right? I hope I'm very much clear on the thought processes, right? Okay, now let's take few examples more, but only with relation to the economic benefits. So let's take the chain for. I'm now going to give you a few assets, and we're just going to decide whether when the economic benefits will arise, will the income tax come to tax it or not, and accordingly I will calculate a tax base. So let me now just give you 4-5 examples. I'm looking at a PPE. Will the economic benefits arise? Yes, they will arise in the form of sale of goods and services. In the form of sale of goods and services, which is equal to the carrying amount of the asset. Will I be, क्या income tax वाले इस पर tax लगाने आएंगे? So they will definitely come. So what will be my tax base? It will be a future deduction. The future deduction means the depreciation. I will be able to claim a depreciation against the taxable benefits. ये जो benefits आएंगे, income tax वाले इस पर tax लगाने आएंगे. मैं कहूंगा नहीं, मुझे depreciation का claim चाहिए इसके against. You will be able to tax me only on the difference. Next, there is an account receivable. Economic benefits definitely आएंगे. You will collect the money. You will collect the money from the debtors. When you go to collect the money from the debtors, sorry. When you go to collect the money from the debtors, will the income tax authorities come? Sorry. When you go to collect the money from the debtors, will the income tax authorities come? No. Why? When you made a credit sale, they already taxed you, so they will not come. They will not come to you. If they will not come to you, why they will not come? Because it is being already taxed. इस पर वो already tax लगा चुके. In such a case, when the income tax authorities will not come, no future action. The tax base and the carrying amount will be equal. The tax base and the carrying amount will be equal in such a case, no deferred tax implications. So we've got two pictures very clear. When the benefits will arise, income tax people will come. Get the chain. When the benefits will arise, income tax people will come. Ask them, what is the deduction you will give under the Income Tax Act? That is my tax base. Get the chain very clear. When the benefits will come, income tax will come. Benefits आए, income tax वाले आए. पूछो उनसे, क्या deduction दोगे under the Income Tax Act? Now you will say, so that means I should have an understanding of the income tax provisions in a practical, I guess. Because my tax base is the amount which I will claim as a deduction against the benefits when they're taxed. मैंने कहा जी बेनिफिट्स आएंगे, इनकम टैक्स वाले आएंगे नहीं, क्योंकि टैक्स हो चुका है. Tax based carrying amount is equal. I hope you're getting the thoughts very clear. See more example. Let's say I have a dividend receivable in my balance sheet. Let's say I have a dividend receivable in the balance sheet. I'm going with the old provisions of tax, that the dividend is tax-free in the hands of recipient. I know the latest provisions, there has been a change, but let's assume that it is tax-free in the hands of the recipient. So when the dividends will arise, when you will collect the amount of dividends, क्या income tax वाले आएंगे? नहीं आएंगे. क्यों? Tax free. Since it is tax free, वो नहीं आएंगे. If they don't come, tax base and carrying amount is same. Are you getting the chain? जब benefits आएंगे, income tax वाले नहीं आएंगे. Tax base carrying amount is equal. जब बेनिफिट्स आएंगे, इनकम टैक्स वाले आएंगे, पूछो उनसे क्या रिडक्शन दोगे अगेंस्ट दोस बेनिफिट्स अंडर द इनकम टैक्स एक्ट. Simple. Let's take another example. Let's say we've got in the books of accounts, let's say interest receivable. Instead of dividend, interest receivable. Now I'm going to give you two situations. Watch it carefully. Interest receivable, the benefits will arise when you will collect the money. Now I'm considering two situations. या तो income tax has already, it says we follow accrual basis, or they say we follow cash basis. Watch it carefully. The benefits will arise when you will collect the interest. Income tax people followed accrual basis. So when you booked an income, they took a tax on that. Now when you're going to collect, do you think they will come? Answer it. Answer it. I think this is wonderful to understand the concept. So what do you say in this particular case? If they have followed let's say the concept of, if they followed a concept of accrual basis, what do you say in this case? Will the income tax authorities come? And that's rightly said, of course, they will not come to you. Why? Already taxed. Why? Already taxed. Wonderful. तो जब आप कलेक्ट करेंगे वो कह रहे हैं हम तो टैक्स ले चुके हैं, वो नहीं आएंगे. सो टैक्स बेस एंड द कैरिंग अमाउंट विल बी इक्वल. नाउ व्हाट्स द नेक्स्ट वन? If they say we will take a tax only when you collect it, cash basis, तो जब आपने कलेक्ट किया तो क्या वो आएंगे टैक्स लगाने? Yes. Now tell me, क्या आप इनकम टैक्स वालों को ये कह पाओगे इस इंटरेस्ट को कलेक्ट करने में मेरे खर्चे हो गए? Does the income tax authority give you a deduction against the collection of interest money? No. The Income Tax Act does not give you a deduction. You can't say that to earn the interest, I am going to claim a deduction against the interest. No deductions are allowed. So the tax base will be the future deduction, which is zero. Because they will not give you a deduction against this, so we can say it would be zero. I hope you get the chain of thoughts very clear. Let me just consolidate the picture once again, friends, to you. So let me just consolidate the entire picture once again to you. You need to go with a very important chain. You need to go with a very important chain, and the chain goes like this. You're going to put across a question to yourself. When future economic benefits will arise, will income tax people come? The chain is very simple. In simple words, आपने अपने आप से क्वेश्चन पूछना है, जब बेनिफिट्स आएंगे, बेनिफिट्स तो आएंगे. Every asset will give you benefit, undoubtedly. Every asset will give you benefit. So you will say when the benefits will arise, benefits तो होंगे arise, income tax वाले आएंगे आएंगे अच्छा आएंगे पूछो उनसे क्या डिडक्शन दोगे So the tax base is the future deduction. अगर income tax वाले आएंगे the tax base is equal to future deduction. The benefits will arise. Second situation. But income tax वाले नहीं आएंगे तो tax base is equal to the carrying amount. Simple and straight. The tax base will be future deduction. अगर वो आएंगे and the tax base and carrying amount is same, वो नहीं आएंगे. उनके ना आने के तीन reasons हैं. उनके ना आने के तीन reasons हैं. Number one, already taxed. Number two, it is exempt from tax. And number three, it is capital receipt. It's not income. It's a capital receipt. It's not income. Now look at the definition again and you will get the chain. The tax base of the amount that will be deductible for tax against any taxable economic benefits. What is the tax base? Future deduction against economic benefits which are taxable. And see what it says further. If those economic benefits are not taxable, the tax base is equal to the carrying amount. Trust me, friends, I have given you just the concept. I have given you just the concept on the definition. It must have been a little technical to understand, but trust me, this is the concept. So the chain is very simple for asset. Whenever you are calculating a tax base of the asset, we'll do some examples with that also, but not today. I don't want to put too much pressure on my voice today because it's been a little bad 2-3 days back. So we'll be, taking a little half class today. I'll be taking a little lengthy class tomorrow, and then Sunday we'll also, compensate for the loss so that we are able to complete the topic good in time. So when I'm looking at the tax base of an asset, you got to get the chain very clear. Benefits to आएंगे. That is not doubtful. Every asset will give you benefits. So benefits आएंगे. आप सिर्फ ये पूछो जब benefits आएंगे, income tax पर आएंगे, future deduction is the tax base. नहीं आएंगे, tax base carrying amount same. और नहीं आने के तीन reasons हैं. Exempt, capital receipt, already taxed. I hope I am very clear with this. If there need be, go through this video again. You'll get the chain absolutely clear. I'll be taking some examples also in this area with you tomorrow indeed. So I think there's a question, Namrata. If capital receipt is taxable as capital gain, then what will be the income? Well, if you're looking at a capital receipt, I guess if you're looking at a capital gain, you can't call it as a capital receipt which is taxable. A capital gain, a capital receipt would be, okay, let's take an example. Let's say you've got a loan receivable in the balance sheet, the principal amount of the loan. Now, when you go to collect the principal amount of the loan, do you think the income tax authorities will come? आपने किसी को loan दिया and you collected that money from the person, the principal amount of the loan. They can tax you the interest on the loan, but they can't tax the principal collection of the loan. So will they come? They will not come. Why? It's a capital receipt. I guess you got the answer, right? So we are looking at a capital receipt in the sense that when you go to collect the money, it is something which is a capital receipt. It's not the income. It is not subject to taxation. So rather than saying a capital receipt, I can rather say that this is something which is not subject to tax. I think that would be better to say that it is not subject to tax. So if it is not subject to tax, no tax implications, then it falls under this case. right? Okay, so I guess friends, I'll have my apologies once again due to a little bad throat condition. So will take a half day today. So tomorrow I'll be joining you once again, and pretty sure that I should be able to take a little larger class. I don't promise that I'll take 3 hours, but maybe around 2.5 hours. But Sunday we'll be having a class. So let me just, I can give you the inputs that we will take a class on Ind AS 12 in this manner. So today I have already taken a class for like 1.5 hours. Then tomorrow I'll be taking a class a little extended time, so almost 2, or maybe try to take a little more. And then Sunday we'll be taking a class again at 7 to 10 in the morning. So whatever shortfall is meant out here, we will cover that on Sunday, because approximately we need around a 6 hours time to do this standard. So we will cover up the balance on Sunday. I hope I would be much more energetic on Sunday. Things are improving, but I don't want to take too much chances with the neck, because I think that's something very crucial and important. So thank you so much, Koshki. Thank you, Namrata. Thank you for the inputs. So I guess once I'm going to take a leave from you right now, and I'm going to join you back tomorrow morning once again. Thank you very much. So please do revise these concepts. We're going to take the journey forward tomorrow. Thank you.